Give it a second, give it a second. Alright, and good morning, good evening, good afternoon, students and traders and analysts. How is everybody? Yeah, this is Forex 4 and open. Give it a second. And classes, right? Happy Wednesday, everybody. Welcome to the Professional Forex Trading Course 101. This course is for beginner traders. If you want to become a professional trader, this course is for you. If you want to become a fund trader, this course is for you. If you want to become a hedge fund trader, this course is for you too. Alright, never forget what are we trying to do here. We are trying to... One more? No. We are trying to become a professional trader in an institutional way, right? What does this mean? 1 year of Forex course 101. Alright, it's all about the market, and then this is the learning phase. And then if you want, not mandatory, but it's good. And now it's Forex course 202, it's the money phase. It's all about the business. You know? What do institutional traders know that you don't know as a retail trader, right? And then Forex course 303, it's not for everybody, not necessary. You know, it's for, yeah, it's the richest phases. Why some traders are driving Lambos and others are buying pizza with the money. It's an interesting session too, right? Never forget, you're going to graduate from this course when number 1, you have your chart set up and ready for trading. Number 2, you have a strategy in place, you understand why you win and why you lose. And number 3, you have a complete understanding on how this market works, so you can analyze the market and make an educated prediction. Risk disclaimer, this stream is not trading or investment advice. We are here to learn, and for homeworks you have the Gmail, and for extra webinars, classes, Forex course 202. Melissa, I'm not sure if you're here. I'm going to send you a link on Zoom. Skype doesn't work today. I had a few sessions in the morning and Skype just didn't work. Alright, if you want the free manual, yes, free manual, send me an email. So let's see, what do we have here? Do we have equities, entries, and equity management? Do we have entries? Bullish, bearish, bullish, entries, and equity management. Wow, let's see. Lesson 37 from the manual, trading Japanese candlestick, entries, and equity management. Different pattern that we trade offer different equity management. You might write this down, everybody. After drawing market wave, shortened trend and trend lines, can we enter the market based on this last candle? Forex course 101 trading rule. This last candle is the monthly chart, is still forming, so we cannot use it to make a decision. On any time frame, we cannot decide on a forming candle, a moving candle. We need to see the body of the candle to close. This from the manual, yes, very good. Monthly forming candle is not suitable for making decisions. Talking about different patterns and equity management, we are going to have a few questions. Counter trend break on the daily chart. Would you short the market? Red circle. Is this a candlestick formation? Inside the red circle, I would say yes. And talking about patterns, where would you place the stop loss? Alright, so let me check. Forex course 101, learn the skill. You could have the same entry but totally different risk in terms of pips. Alright everybody, so before moving, let's simplify this lesson, alright? Out, close, close. Which one is less polluted? All right, there you go. And it's a great lesson. It's another interesting lesson. All right, everybody. So entries. We're talking about entries, and we're talking about equity management, meaning making money. Equity management, all those fancy words, right? So making money. All right. So entries are based on your entry setup. The entry is based on your entry setup, and we've learned so far that you can enter not direct entry, so you can enter with the counter trend line break at support / resistance / PP pivot point, and now we have candlestick formations. Alright, this is about the entries. The entry is based on your entry setup. How you're going to enter, there is no right or wrong. You can enter with the counter trend line break, at support, resistance, pivot point, candlestick formations. Now equity management is another one. So equity management is based on where you put the stop loss, where you put the take profit, and the relationship, meaning risk reward ratio between the stop loss and take profit. Alright, everybody? I'm going to explain, give me a second. Equity management is based on where you put the stop loss, where you put the take profit, and the relationship between those two, right? So first the theory, then we're going to look at the chart. Alright. If this is the market wave, alright, you have an up market wave, everybody. Something like this. And then you have the short-term trend, higher highs, higher lows, higher highs, higher lows. Blue, and like this, and like this. Higher highs, higher lows, retracement, lower low, lower high, lower low, lower high, lower low. And now you have a higher high, higher low. Alright? And maybe another higher high. So entries and equity management, right? Here is the question. How are you going to enter in here? Why, boss? Why? Because you can have 3 traders looking at the same chart, and each and every one is going to enter differently. Can you understand this? Boss, can you repeat please? You could have 3 traders looking at the same chart, and those 3 traders are going to enter differently. So you have a different entry. Alright? Now let's go with number one. Right, not this one. Give it a second, give it a second, give it a second, give it a second. So, alright. So, somebody is going to enter with the counter trend line break. Can you understand this? Somebody is going to buy vertical line. Somebody is going to enter here. Alright, everybody? Because it's a counter trend line break. He or she, they don't bother about candlestick formations, they don't bother about support, resistance, pivot point. Alright? This is if the trader is trading the yellow one, exactly, the yellow one. Why not the blue one? Because you are still in a downtrend. You are still in a downtrend here. Alright? Brota says, I choose candlestick formation. All good. So it's still a downtrend here. Alright? So if you would trade the blue and enter in here, premature entry. Premature entry. Alright? Alright. Somebody who is going to trade the blue is going to enter at this counter trend line break. Or maybe based on the strategy, now is going to enter on this counter trend line break. Alright? So we have counter trend line breaks on the shortened trend, counter trend line breaks on the yellow market wave. Now if we move to equity management, which is a fancy word to explain making money, equity management is based on where you put the stop loss, where you put the take profit, and the relationship between the stop loss and take profit in a series of 100 trades. Very good. I almost forgot. In a series of 100 trades. In a series of 100 trades. Alright? Now, should be 1 for 1, 1 for 2, I don't know, up to you, but somebody who is entering here is going to put the stop loss down to here, and somebody who is going to enter in here is going to put the stop loss down in here. Can you see it, everybody? The difference? Same entry, different stop loss, not different risk, different stop loss level. Oh, so it's the same. No, it's not. But it's the same risk. Yes. Yes. And by the way, it's a great question. Everybody, question for understanding. Question for you to understand equity management. If two traders risk the same risk, example 1%, but they have different stop loss levels, example, one is trading the STT shortened trend, the other is trading the market wave, are they going to lose the same in 1 month? Yeah, it's not the correct question. Alright, give me a second. Are you losing the same? The same in an up or down market? All right. A student said, not on YouTube, but YouTubers too, a student said, oh, so if I'm risking here 1%, and if I'm risking here 1%, so those two are the same. The violet rectangle is the same as the black rectangle. And I said, no, those two are not the same. And the student answered, well, but I'm risking the same risk, so this must be the same. So here is the question for you to understand equity management. If two traders risk the same risk, if this loses, is going to lose 1%. If this loses, is going to lose 1%. But they have different stop loss levels. Example, one is trading the short-term trend, the blue, another is trading the yellow market wave. Are they going to lose the same in an up market? What's the answer? YouTubers shoot. What do you think? Is it possible that after 100 trades, one trader is going to do 100 trades on the short-term trend, and they are. Another trader is going to do 100 trades on the yellow market wave, and they are. Is it possible, talking about losers, that those two are the same, that this stop loss has the same risk in terms of the market stopping you out compared to this stop loss level? Wow, this is an interesting question. What do you think? We have two types of risk. We have three types of risk. Number one, the monetary risk, 1%, 2%, whatever. Number two, we have the risk of being stopped out, and we have also the risk of the market not hit. The risk that the market is not going to hit our take profit level, but reverse instead and eat our profits. Wow, right? Did you know this, everybody? Did you know this? Maybe yes, maybe no, right? I don't know. Did you know, everybody, that when you trade you have a monetary risk? If you are stopped out, how much you're going to risk in, how much you're going to lose in monetary terms? But you also have two more risks. You have the risk of being stopped out, and this is what this question is about. And you have another risk that the market is not going to hit our take profit level, but reverse instead and hit our profits. So, question for you to understand equity management: if two traders risk the same risk, they have same monetary risk, but they have different stop loss levels. This is going to trade a short-term trend, stop loss down in here. This is same entry. They have the same entry, but this is going to have the stop loss down in here, right? So are they going to lose the same when it comes to losers? Are they going to lose the same in an up market? Type in the chat, what do you think? Hedge fund trader Broto, hedge fund trader Melissa, hedge fund trader Singh, hedge fund trader 4K, hedge fund trader Clara, hedge fund trader Ernesto, hedge fund trader Shola, hedge fund trader Ala, who else is there? Hedge fund trader Julius. What do you think? And everybody else online. Yeah, it's not an easy question. You need to think, right? What do you think? There is no right or wrong, everybody. What do you think? James says no, Broto same because they have different take profit. The answer is, everybody, no, those are not the same. Make sense? The answer is no. Why not? Broto, listen up. If this is the market wave, right? And the market wave, of course, has the short-term trend. And here is the one example, you know. Give me a second. Alright. Up in here, up to here. There you go. So the trader who is trading the short-term trend is going to put the stop loss down in here, alright? Another one is going to put the stop loss down in here. If the market stops this trader out, right, like this, is he going to buy again? Well, it depends, right? But if the market does lower low, lower high, lower low, are we in an uptrend or are we in a downtrend? So here this trader has 1% loser, and then the market is going to make higher high, higher low, higher high, higher low, higher high, higher low. The short-term trader is going to enter again, right? Agreed? No. Of course, yes, because this is what you trade. Make sense, everybody? You cannot pick and choose trades. If you are in your strategy, if you are trading the short-term trend, so we've entered here, counter trend line break, you know, stop loss down in here, and the market stopped you out, and then you see that this short-term downtrend one more time is pushing up to an uptrend, you are, or you must enter again. You cannot pick and trade choose. I mean, you cannot choose, pick and choose trades. So if the market for any reason, let's say that it's in consolidation, right? So here is the second loser on the short-term trend. This market just maybe is in consolidation, just maybe. You know, it's like this. Consolidation is difficult to predict, but it's not true that just because this is risk in 1% risk, monetary risk, and this is risk in the same 1%, it's not true that in terms of the second risk, they are the same. We have the risk of being stopped out. So when you trade the short-term trend, not being right or wrong, when you trade the short-term trend, the risk of you being stopped out compared to the market wave, it's higher. Make sense? Boss, I don't agree with you. Good. Study the charts. Study the charts. Actually, you're not agreeing with me. It's great. Clone chart. NZD CAD maybe. Looking here. Seeing here. Seeing here the short-term trend. Short-term trend. Right? If you've entered here, shorting the market, example, fair enough, you would be stopped out. And if you would short the market here, going down, you don't see the future, it's a downtrend, you would be stopped out too, agreed? Where the market wave so far, this is the relevant high and this is the relevant low. Can you see it, everybody? Just an example. Study the charts. Boss, I don't agree with you. Boss, I don't like what you teach. I don't care. This is all good, but you should study the charts and prove me wrong. Should always see the bigger time frame to see the bigger wave. Yeah, the answer is yes. Alright, everybody, are we clear? So, equity management works on all of this, right? Exactly. It's not just the entry. The enter in the market, this is the easy stuff, right? But understanding how this game is played, in the Forex course 101, it's all about the market. Understanding that you are playing chess with the market. If the market does this, I'm going to do that. If the market does that, I'm going to do something different. This is a great part. And another risk is, but this is for the next time, let's address, all good in here? Equity management, it's different. No, this is not better because on the other side, the short-term trend makes quicker profits. Fair enough? If you are trading the market with the yellow one, then your stop loss is safer. Yes, it is. But compared to the blue, when we go on the money side, it's going to take you much more time. The market wave takes much more time to fulfill the 1/2 risk reward ratio. So the blue, the short-term trend, it's quicker. Make sense? But it doesn't change the fact, if my stop loss is too tight, that maybe this is something to be addressed. Unfortunately, there is no right or wrong. Somebody's asking me, boss, what is better, counter, trendline break, support, resistance, candlestick formation? There is no right or wrong. Now, let's address candlestick formations. So, somebody else is going to enter with the candlestick formation, and somebody is going to enter with the candlestick formation like this, and back in line, alright, like this, and is going to put the stop loss below the candlestick formation. Make sense? And this candle could be inside the short-term trend too. Now, so everybody, do we understand that this is a guessing game in terms of probabilities? Alright, so golden nugget. Hopefully it's not too complex. Golden nugget. It's statistically proven that when the market goes your way, candlestick formations offer the best equity management. But on the other side, is also proven that if you are in consolidation, you are going to lose more faster. Alright? It's statistically proven that when the market goes your way, candlestick formation offer the best equity management, meaning the stop loss goes above or below the candlestick formation. Alright? But on the other side, it's also proven that if you are in consolidation, you are going to lose more faster. You're going to lose faster. More faster. My English, more faster. You're going to lose faster. So if we go on the chart, where is the chart? Down in here. If you go on the chart, everybody, this is what? This is Euro New Zealand, right? Euro New Zealand. Alright, this downtrend, just an example. Right? Okay. So here is a counter trendline break, and 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 here is a counter trendline break. Just an example, alright? So here we have a candlestick formation, 1, 2, 3, 4. Alright? and high to low, low to high, high to low, low to high, right? Just an example. So I'm going to short these candlestick formations, and the stop loss is going to go up in here, above candlestick formations, instead of clone going up to here, right? So it's when the market goes your way, clone for our chart, and clone for our chart. When the market goes your way, you are going to profit take much quicker. Does this make sense, everybody? Here you have a candlestick formation too, the dark cloud cover, you know, and you put the stop loss above in here instead of still up in here. The market didn't make a lower low, and if this is your stop loss, no, there is no right or wrong. You must just understand. Everybody give me a second, and clone. Can you see it? And this is a candlestick formation too. Stop loss up in here, and 1 per 2, clone, and boss, that's the good news. Calm down. I wish it would be that easy, right? Just buy or sell, calm down. Alright? Now, you are still trading the same short-term down. Listen to me, everybody. Try to focus right now, okay? What I'm going to say. You are still trading the red downtrend, right? On the 4-hour chart. So, because you've entered here and used candlestick formation for the stop loss, you profit take already here, and here you did the same. You used candlestick formation to enter the market and for stop loss, you know, and you profit take here and here, right? Now if you would use this counter trend line break as an entry, you know, trading the same pattern, but because the stop loss is up in here, then this would be, in terms of time, can you see the difference, everybody? Boss, I'm confused. I'm trying to explain to you that you can put stop loss on different patterns, and these different patterns are going to give you money in different time, but on the other side is going to eat your money in a different time. Can you understand this, everybody? YouTubers too, can you understand? Do you understand the conversation? It's statistically proven, sure, that candlestick formations, when the market goes your way, offers the best equity management, risk reward. Gets filled quicker, and you can also go 1 per 3, 1 per 5, whatever, right? I mean, look in here. Can you see it, everybody? Well, down. You don't need to close the trade in here. You just maybe let it run. I don't know. Alright? But for the trader who said, oh, this is really good news. Now, not that easy. If this is an uptrend, right? And you enter with the candlestick formation in here, and you get stopped out, and the market does this, and you short the market. You short the market with candlestick formations, and the market goes up and stops you out and does something like this, and you or buy or sell, whatever may be the case, because you are in consolidation, or maybe there is a chaos coming on pattern that you are unaware, then this same statistic that says candlestick formation offers the best equity management when the market goes your way, with the same logic here you are going to also lose faster. Make sense? You're going to lose quicker, more quickly. You're going to be stopped out on candlestick formation stop loss, where compared to this stop loss where you would be safer. Let's not confuse entries with equity management, everybody. Let's not confuse entry with equity management. James says it would be a better entry. Alright, everybody? Study this lesson, study the charts. I don't know, you need to decide. You need to decide, talking about your strategy, you need to decide how are you going to enter. There is no right or wrong. You can enter just with the counter trend line break, you can enter just with the candlestick formation, or you can enter with all of them. You can enter when the market is going to break the counter trend line at past support with candlestick formation. This would give you a better chance. But the big one, it's about the risk. You need to decide, or your stop loss goes below, in this example, below the candlestick formation, like we see on the chart, or below the highs and lows of the short-term trend, or below the market wave. Because those three stop loss levels times 100 trades, you are going to have three completely different results. Does this make sense? Alright, everybody, I need to go. See you back tomorrow. Study the chart, do your research. Alright, see you back tomorrow. This is the boss, signing off.